Hello, everyone. Today on the final bar, we will wrap the week. Look Friday close to Friday close. How has the picture changed? We'll see how much we can cover in 30 minutes because I feel like everything has changed, right? Up until this week, it's been all about price strong, breadth pretty strong, sentiment euphoric, which is sort of a contrarian negative. Now we have gone sentiment clearly negative, breadth turning more negative, price turning negative. Ladies and gentlemen, this is the final bar. Hello, everyone. Welcome to today's edition of The Final Bar. I'm your host, Dave Keller. I'm the Chief Market Strategist here at StockCharts.com in a cloudy but okay Redmond, Washington. Thanks for joining us every weekday after the close as we look at these markets together using the power of technical analysis, behavioral finance, investor psychology, price, breadth, sentiment, decision-making, whatever else we need to try to make sense of things. And I tell you what, in interviews that I've done this week from in media outlets and elsewhere, my attention has been pulled in many directions. I think there's so many different themes all coming in together. I feel like the fact that there's a Fed meeting is sort of way in the rearview mirror. It's sort of like a non-issue. The fact that 3 of the FanMag stocks reported earnings this week feel like it got clouded by other things happening, right? The whole supply and demand, the gut check of the markets or the reality check of the impact of individual investors, the impact of social media, how financial firms are dealing with increased order flow, the rise of options trading, the rise of retail trading, and everything in between. There's so many themes. And again, when there's a time like this and there's so much happening, and when regardless of what you think, you can come up with pros and cons, or I guess bullish and bearish arguments from a lot of different places right now. In the end, price is price, right? Price does not get restated. Price tells you where buyers and sellers were able to come together by whatever means at a particular level at a particular moment. I'd say there's truth in price, and ignore the noise, focus on the price. As one of my early technical mentors said, forget the news, remember the chart. And I don't know if I would tell you to forget the news, but I certainly would tell you, if you're going to look at one thing to try to make sense of things, look at what the market's doing. That'll tell you most of what you probably need to know. We have wonderful guests on the final bar. This week was fantastic. A couple of really good guests. My conversation with Julius DeKempner really strikes from Wednesday, talking about sector rotation. Tuesday's conversation with Bruce Powers talked about biotech, Biogen jumping, at the end of the week. So great guest coming up again next week on the 2nd. On Tuesday, we have Tony Zhang. Tony is the chief strategist at Options Play. On Wednesday, we have Louis Llanes, founder of WealthNet Investments, one of my favorite quantitative strategists. On Thursday, we have Leslie Juflas. Leslie's the founder of Trading Live Online. She's a frequent guest host of Your Daily 5, which is one of our other shows on StockCharts TV. Does a really good job with that. And so be interested to get all of their takes on what's happening here. Let's continue on to our market recap. Really on Friday, we wrap the week, which is we try to look big picture, take a step back from all the flickering ticks, all the noise as much as we can. Having said that, I want to start with a poll question. We always have a poll running on our StockCharts TV page and on our YouTube channel, on Twitter. So I'd encourage you to look us up in each of those places and see what you think. Our recent question, the 4 worst performing sectors in Q4 of 2020. So October, November, December of last year were real estate, consumer staples, utilities, and healthcare. Which of these do you think performs best in Q1 in the first quarter? And over half of you, 56%, responded healthcare, which is interesting. It's actually number 2 today. And if you think of the healthcare sector, it's kind of rotated very nicely from a period of, I don't know if I would say underperformance, but certainly was underperforming for much of last year. What I mean is in the fourth quarter, it wasn't a huge loser, but on a relative basis, just didn't get it done. There were just sectors that did so much better. But look at how the relative strength starting to turn higher. You're now getting potentially a higher low and the relative strength. This is healthcare relative to technology at the bottom here, making me perhaps a higher low. A lot of this came from today with a little bounce in the last couple days. I'm also intrigued. Utilities and real estate got a nod. Very few of you said consumer staples. So as a contrarian, I'm always curious what people did not pick. And boy, so far, Final Bar Nation can't disagree with the fact that you'd underweight consumer staples out of that bunch, because certainly not getting it done today, seeing some certain weakness on the downside. The relative strength of consumer staples is what concerns me the most. I mean, in a group of underperforming sectors, you look at where the relative gains have been. In terms of how I would answer that, I would go utilities, healthcare. I get the idea, and I don't disagree. I think you might be onto something for sure. I like the yield in utilities. I like the fact that it's held support, and the relative line, same thing. You're seeing a bit of a higher low here, a potential turn higher. I wouldn't be surprised if both of those sectors do better, especially during a rocky period going forward. But we'll see what we can see. Let's continue on and wrap up this week the best we can. What we like to do is start with our weekly wrap the week chart here. I'm going to update some labels on here. This is a chart which just shows the weekly return in some of the key averages, key asset classes over the last 5 trading days. So starting the clock at last Friday to today, what's happened in these asset classes? The S&P is here down 3.3%. Now, obviously, a lot of weakening going into today and into the close, sort of weaker rather than stronger. So a bit of a downtick, and certainly one of the worst weeks we've seen in quite a while for the S&P. I don't have the numbers, but I would guess this is probably the worst week we've seen since October, would be my guess, during that last sort of pullback period, September, October last year. We had those big down weeks at times. So I wouldn't be surprised that this is the worst one since then. I think that's probably fair to say. The NASDAQ was essentially the market this week, coming off going into Friday or going into the close on Friday. And so both of them down about 3 1/3%. What underperformed stocks? Not much, right? Pretty much most other things, non-equity asset classes did better. Small caps were down about almost 4.5%, 4.4. Emerging markets also down 4.5%. So a lot of weakness. Now, that's China, for example, which gapped up last week, was like the gaps up, the jump higher, the FXI, the MCHI, all making new all-time highs. They all reverted back to the downside. And, what's interesting on a chart like the FXI, we don't have time to get into it. Unfortunately, what you could think about is they've gone so up so quickly and gapped higher. There's a lot of room to come down, just even to reach the 50-day moving average. So, there's a lot of room for the uptrend to still technically be intact, but to give back some more ground. What outperformed U.S. stocks this week? Gold was down about 0.75%. Gold is really in sideways mode, and the chart of gold for me is a jumble of labels and lines, because everything's kind of lining up right about where we're at right now. It's literally the absence of trend, waiting to see which side, buyers or sellers, take control and push gold to its next spot. Crude oil essentially flat for the week. It came off a little bit, 0.1% down. Bonds in the form of the TLT also about a rounding error above zero. The US dollar, the best out of this bunch, up 1/3%. We've talked about this weakening dollar environment for a while and what that means for non-US versus US, small caps versus large caps. Here we see a stronger dollar this week, and we see small caps and emerging markets underperforming, which is sort of what you'd expect in a stronger dollar that's going to favor the larger part of the markets. One thing we do not have on here is Bitcoin. We'll show you this other chart just to show that Bitcoin was certainly the outlier and the winner this week. Down, and it was the worst performer as of Wednesday's close. Over the last 24 hours, we've had Elon Musk changing his Twitter profile to just hashtag Bitcoin. That seemed to be enough to push Bitcoin higher. It's amazing. It's a petri dish of speculation and behavioral biases. It's fascinating to observe, and I would encourage you all to reread books like Humphrey Neal's The Art of Contrary Thinking, if I remember right. That's the name of it. Just, it's from decades ago, but so much of it rings true in terms of understanding crowd dynamics and group theory and how they can impact asset prices. So Bitcoin, the best of the group, and outperforming pretty much everything else this week. Let's look very quickly at just what happened granular today. So, stocks sort of sold off in the morning after lunch, rallied a bit, but gave back most of those afternoon gains going into the close. So finished back above 3,700. I think it's worth noting that it bounced right off that 3,700 level. Big round numbers tend to have meaning. And so a round number, $100 sort of level, usually more often than not proves to be some sort of magnet for prices. So 3,700 is certainly something to pay attention to. The NASDAQ, as I mentioned, essentially in line, mid caps and small caps down as well. Small caps down only 1.5% relative to 2% for the S&P, and the VIX back above 33. Bond prices today down just a bit with 10-year yields back around 1.1%. Commodities essentially mixed with gold, rallying out of the open and sort of a lot of these gaps higher, but gave back most of those gains to finish flat for the day. Silver was one of the only ones finishing more positive. And I mentioned cryptocurrencies overall finishing stronger rather than weaker. In terms of sector leadership, utilities, healthcare, real estate, 1, 2, 3. This is certainly the defensive side of the ledger working today, as I would describe what I've seen this week if I could summarize it. Besides the structural challenges we've had with things like GameStop and American Airlines and other names like that, it's just this general de-risking. It's a rotating to the defensive side of the ledger, taking bets off. So you see energy, technology, consumer discretionary at the lower end of the return profiles today. Let's complete this wrap of the week by looking at the Mindful Investor Live chart list. As a reminder, we'll spend the rest of our wrap the week segment here. If you've not seen this before, this is what we do every Friday. You can access this exact list. Just go to the articles page on your StockCharts dashboard at the top. Click on articles. Go to mine, which is called the Mindful Investor. That's my page, and you'll see a link at the top to this live chart list. You're welcome to save the charts. Do whatever you want with them. We're going to start with the weekly trend model, and I feel like have been a broken record really since October, telling you the long-term, medium-term, short-term trends all positive. That now changes as of today, given the weakness that we have going into the close. The short-term model has turned negative. That's the first time it's been negative since late October. So the previous two times it was negative was here in June, which is during the June market pullback, in October, and in November. So basically coming off the September highs, you have that choppy period of pullbacks before the resumption of the uptrend in November. All three of those, sort of the three most significant pullbacks in 2020, besides the big sell-off in March, all had the short-term model turning negative. It's once again negative. So it definitely tells me on the tactical side, the path of least resistance is down until proven otherwise. I'm really close to this one, and I hesitate to call this a sell signal because it's literally, out to 3 decimal places is right at 0. So I guess I will have to call it a not negative yet. I guess it's sort of like in football, the receiver gets the benefit of the doubt in a reviewed call. So we'll call that still with offense, but boy, it is on warning as being really close to a sell signal in the medium-term model. And for me, when I'm thinking about asset allocation, the medium-term model really is sort of the go-to. The long-term model is really meant to capture these secular moves and tell you when you really need to just get away and look for, and think about the downside potential and prevent maximum loss. But the medium-term model is really more of the money management side of it. So the fact that it's really close to turning negative is certainly going to have my focus going into next week. I think you'll know very quickly as next week starts, on Monday, where you'll see whether or not we have further downside. Now, the short-term chart, the daily chart of the S&P, to me, certainly speaks to downside potential. What's interesting is we closed almost to the penny right at the 50-day moving average. What we've talked about is, things that I would be concerned about if I'm short-term bearish. Number one would be the trend lines off the lows and that being broken. That actually happened on Wednesday, and I think given today's lower close, we now have a validated breakdown. We sort of bounced yesterday, which could have been a reversal back above. We did not get that. We've now confirmed the breakdown, and for me, the short-term trend is lower. We've now broken down through the most recent swing low. That's around 37.50. We've now broken that. The 50-day moving average is sort of the last thing, in my opinion, I've seen enough to suggest I'm going to assume the trend is lower going into next week and start thinking about, further downside potential. Think about what deeper pullbacks could be. So, for me, and I hesitate to draw too many lines on a chart because I think the problem when you do that, and techniques that I've seen that have a lot of lines on it, the problem is you will find something that lines up with something, and I don't want that to be my approach. I want my approach to be much more disciplined and focused on market behavior and investor behavior and market memory. So for me, seeing the fact that if I take the low in October and I take the high from last week or this, beginning of this week, we made a new swing high. You pull back from there, 38.2% is right below 36.50, which around 36.30. That actually lines up beautifully with these lows, with the low from mid-December. This is where we hit a couple times here. It's the upper end of this green shaded area that we've had. So for me, tells us we're right at that point. That would be sort of the the last line of defense. I think as long as we remain above that, I think you could make an argument that this is a viable pullback before the next move higher. I think how a lot of individual stocks behave around this period will tell us a lot about what to expect there. If and when we break that, and I would, again, if you ask me to tell you where I think is the most likely scenario, I think we get down to around 3,200, 3,250 at some point over the next 4 to 6 weeks. I wouldn't be surprised. That would pull us back to the lows from September, October. I will tell you I'm wrong when we start reverting higher and we start making another higher low. But until then, tactical trend is lower. So right now, all eyes for me, the 50-day moving average, and if we bounce off of that or not next week on Monday, really. Further from that, does 3630 hold? That would be the 38.2% retracement and the lows from December. And if not, it's trying to think about the further downside potential. And if the RSI remains above 40, in general, that tends to be more of a bull market characteristic. We spent a lot of time there on the daily S&P chart. Sorry, I was all excited to go through some of those details. Other things to pay attention to going quickly, and I hope you take some time to review the rest of these charts over the weekend. Cumulative advanced decline lines and whether they were able to hold the 50-day moving average. I wouldn't be surprised once these update a little later this evening if the NYSE and the S&P advanced decline lines break down through their 50-day, which would be really telling. We've seen a successive lower number of 52-week highs. We've seen less and less stocks holding their 50-day moving average. So from a breadth perspective, as we've talked about, the picture has gotten less and less rosy and less confirmational of a market uptrend. Finally, we have sentiment readings that look a lot like similar topping patterns. So the AAII numbers, the name exposure index, the RIDEX flows, all at euphoric levels now coming off a little bit, which to me, especially the name exposure index, speaks to people taking their foot off of the gas. It makes sense to have further downside as we digest recent gains, we reset, and then we determine whether or not there's a next leg higher or there's deeper downside to be had. That's all we have time for the wrap of the week. Let's make let's do a quick commercial break, back answering your questions in the final bar mailbag. We'll see you in a minute. Hello, everyone. Welcome back to the final bar. This is Dave Keller here at StockCharts.com. It's great to have you with us every weekday after the close as we look at these markets together. I tell you, if you are looking for a time to get into charting and technical analysis, I think you have chosen the right time. Hopefully the right time is well before now, early on in your trading experience, your investing experience. But if you're not experienced with these tools yet, I hope we're able to help point you in the right direction. And one of the things I think we can do to help you along the way is answer your questions. Questions will come up as you're analyzing charts, as you're learning new technical approaches or technical indicators, as you're seeing what others are saying on social media or on financial television. Shoot us an email with any questions that you have, and we'll do our best to answer them on the air. The final bar at StockCharts.com is our email. On Twitter, we're at FinalBarSCTV. Just drop us a comment there. Or on our YouTube channel, just put a comment below the final bar on the video that you're watching, and we'll do our best to answer them in our next mailbag segment. Let's open up the final bar mailbag. These are all questions that have come for you in the last day or two. And again, I appreciate so much all the questions you've sent. We'll do our best to get to as many as we can. Question number one. Hi, Dave. I've observed on Twitter a lot of technical analysts using DeMark indicators as a tool to either get long or short. Are there any plans for StockCharts to add this helpful feature? That's a great question, and thank you so much for that. Certainly, we're open to adding a lot of different techniques, and with the ACP plugin environment, if you've not seen it, we're adding more and more third-party indicators, third-party approaches onto the platform, and certainly we'll keep looking at things like this. I'm actually very familiar with the DeMark indicators. Earlier in my career, I worked with Tom DeMark and spent a lot of time analyzing markets using his approaches. And I will tell you, they're very unique in terms of how they think about trend exhaustion. You hear a lot of the language that I use probably comes from some of my experiences with what I saw using DeMark indicators, because it's all about defining the trend and then anticipating when that trend is over. And I always talk about that. That's the third piece. Question one, where's the trend? Question two, how can you follow that trend? Question three, how do you know when the trend might be exhausted? And techniques like TD sequential, which is one of the DeMark indicators, is designed to pick out those turns. So certainly we'll look at it. If you have other things, suggestions of other external techniques, third-party techniques that we should take a look at, shoot me an email, thefinalbar@stockcharts.com, send it to our support desk. We track all that. And the more requests we get for something, the more likely we are to get them on the system. Next question, is it worth discussing risk management for a runaway stock like GME or some of the other earnings beats short squeeze chart list? Personally, I owned some GME off the 20-day moving average around 1750. I'm summarizing here, sorry. How does one truly manage the winners that run, even the most conventional growth stocks? Does it come down to personal risk tolerance and setting parameters for yourself? So I will tell you, I mean, anecdotally, the number of people who are not, I would not consider investors or traders that have asked me questions about charts like GameStop, extreme. And anecdotally at conferences with peers in the industry, we'd always joke about our taxi drivers or later our Uber drivers. And if they asked, a lot of times you're asked what you do. And when you say what you do, if they ask a follow-up question, implying that they want to get some good stock ideas, that would always be a frothy sign of market euphoria. Every sign like that anecdotally that I could have gotten, I think I've gotten by now in terms of questions and texts from friends of mine from years ago. So from the anecdotal frothiness level, I think we've gotten it. But in the end of the day, let's say you just own a stock like this where something crazy happens, and for whatever reason it is, what do you do? So, I would tell you that a lot of techniques that I would recommend that are, for risk management is a lot of times based on trading ranges. It's based on moving averages, based on average true range is a common one. And the challenge with anything like a GME or any of these other that have sort of gone vertical, or even something like Tesla or Plug Power that have had good runs that start to, increase exponentially and get away from some of those risk measures. It's all about having an awareness of where you're able to lock in risk. And what's good when you have a position that's working is you have the ability to keep bumping up your stops and keep locking in paper profits and identifying a clear point at which you will take at least something off the table. So, is there a right answer? No, I think there could be a right answer for you. It depends a lot on your risk tolerance, on what questions you're trying to answer as an investor. So I can't give you any specifics, but I would tell you, looking at things like average true range, looking at things like the chandelier exits based on that sort of methodology, looking at just support and resistance levels, and thinking about a couple things. Number one, as a position is working, as a trend is going up, making sure that you're bumping up your risk tolerance. What you do not want to do on a chart like this is say, as soon as it hits the 50-day, I'm out. And then all of a sudden the 50-day is 90% away from the price or something. It's no longer that helpful. And I've seen people, unfortunately, hold on to an outdated risk level. So make sure that you're updating them appropriately and thinking about what makes sense given the volatility of the stock. The other thing, remember, it's not I think a lot of people when they're getting started think of things as all in or all out. It's a binary thing. I own the thing or I don't. Remember, I think successful investors think of things in phases. You can scale in a position, out of positions. You can take partial profits. You can think about where you would take a certain action and then complete that action given some confirmation. I think getting to those sorts of thoughts would be really, really valuable. Next question, can you point me towards a resource that discusses and educates on what moves the bullish percent indexes? There's obviously a distinct correlation between the market swings up and down. I've got a lot of questions on this over time, and I tell you, as much as I can, I'm going to do my best to try to record some sort of special on this. But I will tell you, I'll give you the quick version, and then I'll tell you where you can find more. To see the bullish percent indexes, go to Charts and Tools, go to the market summary page, which is this one, switch to table view, and at the very bottom, you're going to see these bullish percent indexes. We track them for everything. I mean, most things, sectors, major averages. The S&P one is the one I use the most. They're really designed to be used in the point and figure chart format. And what this basically is doing is it's taking 500 point and figure charts. A buy signal on a point and figure chart is where you have an column of X's that goes higher than the previous column. The X's track uptrends. Every time this goes up 2%, you add another X. If we go down 6%, we go down 3 boxes. It's called the reversal. You add a column of O's and you add 3 O's and you sort of track it. So instead of tracking price over time, it's basically tracking trends and looking at uptrends and downtrends. This is telling you the fact that it's at 52%, it says 52% of the S&P 500 charts are currently above, their most recent signal was a buy signal, a column of X's going above the previous column of X's. If this goes below, the further this goes, this means more and more of the point figure charts of those 500 individual stocks are all rolling over and are starting to generate sell signals. So just like you would look at advancers, decliners, or something like the McClellan oscillator, or something like new highs, new lows. It's just basically a way of measuring participation and looking at all the stocks that make up the S&P 500 or the NASDAQ or a sector and telling you what percent of them are in a buy phase or a sell phase. The percent tells you the percent in a buy phase. And there are general ways to do this. If it's above 70%, that tends to be pretty positive. If this goes back below 70%, it's called a bear alert, which tells you the potential warnings of a reversal from an uptrend to a downtrend. If it goes below 50%, that's another signal. Below 30%, it's another signal. If I completely lost you, and I may have, click here in the little magnifying glass in the upper right corner, type bullish percent. You're going to get something like this. Make sure you look at chart school articles, and you'll find this thing that says bullish percent index. This will tell you the methodology, explain where they come from, show you examples of what the signals are, and then some techniques on how you can actually use them. And I mentioned things like the bull alert, bear confirmed, that all listed out here in terms of what that actually represents. I've made a couple notes. When I'm ready to record another special event, maybe I'll use this and think about it a little more. But at the moment, it's sort of in the bear alert phase, very close to signaling a bear confirmed, which would be over half of the S&P is now in a sell signal on their individual point and figure charts. We need to continue on. That was a great mailbag and some really thoughtful questions. Thank you guys so much. Keep them coming. We'll do another mailbag segment on Tuesday of next week. Until then, let's continue or complete the show with the 3 and 3. Chart number 1 is our market trend model. It's something I've been using for a number of years. As of Friday's close, looks like the short-term model has turned negative for the first time since October, and I think that's noteworthy. We are now, in my opinion, you classify where we're at right now with previous pullbacks. The question now is not whether we're in pullback mode. I would argue we are. We could turn around on Monday and shoot the moon. I just think it's highly unlikely. I think at this point, we're going to have to do some more backing and filling to alleviate the euphoric and the sentiment and the negative breadth readings that we've seen so far. So the question now is it a short-term pullback like last September, last October, June of 2020, or is it something deeper like early 2018, like late 2018, like early 2020? And I think looking at where the prices of individual stocks and the market are relative to key support levels, moving averages, will tell you the difference. Chart number 2 in our 3 and 3 is looking at breadth in the form of the cumulative advanced decline lines. You can see we're starting to update these values as we're processing closing data, and it looks like the S&P advanced decline line is going to get back below its 50-day moving average for the first time since September, really. This is meaningful, I think, if you have a scenario where the S&P is not quite breaking its 50-day, but some of these advanced decline lines are. That tells me to think more negative than positive. My bias is going to be negative. I drew red lines on this chart, which for me visually are looking for what lines in the sand would tell me that these are changing from positive to neutral, or neutral to negative, or more bearish. Finally, growth versus value. There's been so much talk about the return of the value trade, and overall this ratio has been trending downwards, but it's worth noting we've had a bit of a bounce this week as things like financials and energy, which had such a great run last year going into the beginning of this year, that's totally changed. And it's been more about, mega cap leadership. It's back to tech, and it's back to consumer. It's back to communication services. My question is, have we seen, was that just a blip of value leadership? And now we return to, what could be more defensive growth? I think the FANG charts will be one way we track that. I think the strength in semiconductors tells you if we're back in growth mode or if value is going to continue to do well. But I would be paying special attention to this chart to see if we continue to want to lean into more on the value side of the coin. Folks, that is a wrap for this week and a wrap for the show, the final bar for January. We'll see you in February as we launch the show back again in Monday. Special thanks to all my guests this week, and keep your questions coming. We love to hear from you. For StockCharts.com in Redmond, Washington, I'm Dave Keller. Have a great weekend. We'll see you on Monday.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.